to YouTube. Ok. We are live. Boa tarde a todos. Hoje é sexta-feira, dia 9 de abril. Bem-vindos ao seminário semanal do Colóquio do Departamento de Matemática. Hoje, vocês estão vendo, nós temos dois convidados aqui, na verdade, o palestrante, o professor Albert Cohen, que fala português, e o professor Celso Doria, aqui do departamento, que foi o responsável pelo convite ao Albert. Então, boa tarde aos dois, e agora eu passo a palavra ao Celso para apresentar o nosso palestrante da tarde e conduzir os trabalhos do colóquio de hoje. Muito obrigado. Por favor, Celso. Boa tarde aos dois, e agora eu passo a palavra ao Celso para apresentar o nosso palestrante da tarde.
Desculpa, eu estou sem som aqui por um momento, deu um problema aqui.
Celso, pode começar. Ouvimos você.
Está me ouvindo?
Sim.
Então, boa tarde a todos os professores e alunos do Departamento de Matemática da UFSC. Hoje é um prazer introduzir o speaker de hoje, o nosso palestrante, o professor Albert Cohen, do Departamento de Matemática da Michigan State University, um amigo muito do peito, muito antigo meu, e é um prazer tê-lo conosco. Ele vai falar sobre Pricing Bounds under Structural Recovery Models. Be welcome, Albert.
Muito obrigado. Então, como a Celso falou, isso é um maior prazer para o convite, para dar uma aula. E é verdade que eu falo português, minha mãe é brasileira, e quero dar um grande abraço para meu grande amigo Celso, para meu novo amigo Antônio, e também para minha tia a Miriam e meu tio Obadia, lá no Brasil. E se você me perdoa, eu vou falar um pouco de inglês agora. And so for everybody that's listening, that doesn't speak Portuguese, I do speak Portuguese. It's my first language, but I've structured the talk today in English. Please, if you have any questions in the audience, please feel free to ask in Portuguese, and I'll do my best to translate and to answer. But it is an absolute pleasure to be giving my first talk in Brazil. I've been to conferences in South America and Europe, but never in the homeland of Brazil, of my mother's birth, and so it's an absolute pleasure to be here. I also want to say that it's an absolute pleasure to present this work. This is part of a trilogy of papers we've written. The first two are available on a journal called Risks, which I'm actually on the editorial board for as well, and it's the intersection, I guess, of financial risks and insurance risks. And the third paper is coming out. We've been accepted for the Journal of Credit Risk, and that should be coming out online in the fall, towards the end of the year, and then hopefully in print next year. And the material we're going to talk about today is essentially understanding risk for corporate bonds. I'm going to be talking about the first two papers. So these are back from 2017, and it's an absolute pleasure to talk about them. And we're going to really go back to the basics. And I wanted to take this opportunity to talk about how I view risk in the financial sense from this perspective of structural models, and maybe compare and contrast with actuarial models, what are known as reduced form or non-structural models. So let's get into it. So essentially, stochastic recovery is an interesting problem in general in bond pricing, where usually the accepted rule is about 40% recovery or 60% loss. So if you've got $1 owed to you and on a bond, so it's $1, it's an IOU, it's a promissory note that a company will issue as they're trying to raise capital. If that company goes into default, the question is, how many cents on the dollar will you recover? And usually it's around 40 cents on the dollar, but it can be much higher, even much lower. It really depends on the company, the time that this is happening, the sector that the company maybe lives within. So lots of different aspects that we'd like to try to incorporate into a stochastic model that essentially adds an extra factor. So in the hope of capturing more of the behavior, observed behavior of bonds, we add a little bit more complexity. And so we'll talk about where these ideas came from and what we've developed from that, and some future work that we'd like to do. Okay, so for folks that have done stochastic analysis, you'll recognize equation one is what's known as stochastic differential equation. So under what we call a physical or a observed measure, we can say that in this case here, the incremental value increase or decrease, of a asset price, dA, is proportional to the time evolved, but also to this random sort of risk driver. And so we can say that dA over A, which is the percentage change, so the dA over A, if I was to divide through by A, is equal to mu sub A dt, which is now saying that if I had continuous compounding, the percent increase is now proportional to the time evolved, plus now sigma A dWt, meaning that I'm also going to add a random component to drive the sort of evolution where the dWt can be positive or negative. So, if I'm investing in a risky asset, it's not just continuous compounding, let's say by putting some money in a bank where you get a positive return every day. Sometimes your returns are positive, sometimes they're negative. That's what's reflected here in equation 1. And of course, as I'm legally required, we say that this asset evolution exists on a probability space, which is omega is the set of all outcomes, F is the collection of the subset of all sets within omega, and P is a probability measure attached to those outcomes. Okay, so we're going to try to go back to one of the most standard models, Nobel Prize winner Robert Merton, saying that the assets of a company can be modeled as what's known as a geometric Brownian motion, GBM, and saying that a company will issue both stock and corporate bonds, and we'll say that a company will default in this introductory model at one of two times, either a time capital T, which is the redemption time of these corporate bonds, or infinity, meaning it never does. And so what this model says is that a corporation will issue a whole bunch of IOUs, a whole bunch of debt, and it'll have a redemption time in the future that's absolutely known at time capital T, whenever that is decided, written into a contract. And the total outstanding debt, let's say there's capital N dollars outstanding. If the assets of the firm to be liquidated, let's say, are less than capital N at time capital T, the corporation goes into default. If, however, the assets are above that notional, then it does not default. And so essentially, this is saying that bondholders have the first right or first claim on the assets. And so the value of the bond at time capital T, with the redemption at time capital T under the Merton setting, is if, for example, the assets are less than the notional, then we turn over the company to the bondholders, and so the value of these bonds in totality is capital A sub T. If, however, we can liquidate and we have more than capital N, then the value of these bonds outstanding is capital N, and whatever is remaining is distributed to equity holders. So again, bondholders have first claim, whatever's left over is distributed to equity holders. And for pricing purposes, we're going to assume, and this is somewhat controversial, you can argue, that there exists a risk-neutral probability measure, P tilde, meaning that under that risk-neutral probability measure, all my returns are basically R, whatever that risk-free rate is, instead of the specific company rate, mu sub A. Okay, so plugging this in, whether you use a Feynman-Katz approach or just expected present values if you're an actuary or a financial analyst, no matter how you look at this, I'm going to say that the value today at time little t is the expected present value. So this is the present value discounting using the risk-free rate R, for the remaining time capital T minus little t. This is the time to maturity that's left. What you would get at time capital T. So if you think of a timeline, and unfortunately I don't have a blackboard I can write here, but if you look at time little t, you discount the payment at time capital T, and you also assume that there's an expectation going on. That's what this is. And so if I plug things in and I work through these calculations, I get to the penultimate or the second to last line here, and we say that, okay, fine. If there was no risk attached to it, at time little t, the value of N dollars certain at time capital T would be just simply the present value, which means this is my discount factor. This is $1 discounted at rate R for time capital T minus little t units of the N dollars in total. Now, we're not going to get all that because there's some riskiness to it. Again, so the Merton model says the following. Bondholders have first claim on the assets of a company. This is what we know as a structural model. Defaults can be predicted, essentially that if we could figure out what the assets of a company were today at time little t, I can predict out what they should be at time capital T with some probability. And so I can say that, look, at time little t, the probability I go into default is the probability that my assets at time capital T are less than notional. And in fact, it's a really nice calculation that we go through, just going through the integration and just rewriting terms, that the value of my bond is what it should be under the no default possibility times this discount factor, which is 1 minus not 0, but 1 minus the expected loss given default, which is this term here, under expectation, times the probability of default. So let me stop here, and again, let's just take an accounting, pun intended, of what we've done. N dollars are due to all bondholders out there. And so, truthfully, N dollars discounted should be this. However, there's a riskiness associated with owning these corporate bonds, and the riskiness, the first approach to us trying to figure out riskiness is to say, well, okay, fine, what discount do I take as a bondholder? How much should I pay up front for this risky bond? Under the Merton model, we're saying that you shouldn't pay, let's say, if $100 million worth of total outstanding debt, notional, so N is 100 million, times the discount value. It shouldn't be that. It should be less than this, because we have to account for the inherent risk in owning such bonds, because a company can go bankrupt. If it's a sovereign bond or something that we assume does not have possibility of default, then we just don't have this extra term. But assuming we do, this is how it's reflected. And it's a very nice calculation to go through here. And this is one of the things that I'd like to take my advanced undergraduates or even beginning graduate level students through this calculation. And we say, okay, fine. So here's the model. Here is the first way that we can see how risk has been injected into the modeling for corporate bonds. And again, I'm a recovering physicist. And so in physics, we always talk about energy as being something that's neither created nor destroyed, but it's basically translated into different forms. And here, the same thing with risk. Risk is never created nor destroyed. You can ignore it, neglect it. You can price it. You can try to mitigate it, and translate it to other forms. You can try to sell it off to somebody, maybe get reinsurance, for example, if you're owning a really large portfolio of insurance risks. But at the end of the day, you want to price it because you can't get rid of it. And so in here, the risk that's involved with owning a corporate bond is reflected here. Now, a couple of things that are interesting, and I've been giving this talk, since the middle half of the last decade in various forms. Again, papers were published in 2017. But one of the things that's very interesting is the correlation between the expected loss given default and the probability of default, right? Meaning that if you're in a very high I should put this, if you're in an environment where the probability of you going into default is high, you would probably assume that you're going to lose more money. Meaning that if everybody's going bankrupt, the chance of you uniquely being able to sell your assets off and giving them whatever their liquidated value is to the bondholders, those assets that you liquidate in what we call a fire sale, if people know, if everybody in this sector is selling off because many companies are going bankrupt, the chance of you being able to get a higher price than your competitors is who've also gone bankrupt. That's not very easy. Versus, let's say, maybe you're just unfortunately had some bad luck with your firm manager, and you've been driven into default. But in general, the sector that you're in, or just the general economy that you're in, is doing pretty well. And so you'd imagine that the probability of default is low. You'd probably assume that the expected loss given default is also low. But it shouldn't be 100% correlated. That's the thing to keep in mind, that there are some environments, for example, when we look at what's known as the Miller-Modigliani approach to this, which is talking that the total assets of a company are split upon equity and debt. You could argue that under that model, assets are the main driver of risk. And so the expected loss given default and the probability given default, it seems like they're going to be perfectly correlated. So if you go through this calculation again and just do the under the what's called the geometric Brownian motion and using the log normal distributions underneath that, if you go through the calculations, here are closed form values for probability of default and loss given default. And the main driver, of course, is today's asset price A sub t, right? The A sub t is the stochastic process, and it's floating around in everything. So since it's the single risk driver, my probability of default and my loss given default are perfectly correlated. And if you look at empirical data, that's not necessarily going to be true. This should be highly correlated, you could argue, but not perfectly, because there could be some idiosyncratic risk that you're not capturing in the model. And that's going to be probably reflected in a couple things, maybe in the stochastic interest rates, but also we argue in our work that recovery isn't constant, or recovery isn't necessarily just the assets of a company that the firm manager has accounted for. Meaning that if the firm manager has driven you into default, her accounting of A sub T might not be what the market thinks the assets should be. It could be that they sell at a even greater discount because everybody's hurting in this sector. Or it could be the opposite, that maybe the firm manager has driven you into default, but the assets, when you actually go through the fire sale process, are actually quite valuable, and maybe you shouldn't have gone into default. So we believe that there should be a shadow price for the assets. A, we're going to call it R. But again, under the classical Merton model, if you assume just a single driver of default and recovery, single risk driver, it's quite nice that you can get a closed form solution. And in here, in equation 5 in totality, this is where I stop and use some of the advanced financial derivatives that I teach. And my students and I will work through some really interesting problems. I mean, how do you, for example, given equity prices and their historical volatility, let's say, how do I figure out what my assets and my sigma of my assets are that are within the company? Can I predict what A and sigma A are? And if I can do that, then I can actually go ahead and figure out what I think the probability of default is. So if today I know what the equity prices are listed and their volatility, there's a nice way of solving two equations, nonlinear equations and two unknowns. And I can actually harvest these parameters and, in fact, get an informational estimate. I can figure out my probability of default is. So again, just a quick counting of it. If I assume that I have a model for the evolution of my assets, if I have a default mechanism, and if therefore I say that, and upon that default mechanism, equation 3 tells me how my assets, when they're liquidated, are distributed, first claim to bondholders, whatever is left to equity. And I haven't given the explicit equity price here, but talk about that too. Then I can actually go ahead and do this calculation. I can see our first sort of approach to where that risk is injected into my model is right here. And so I'm very curious to figure out these two quantities here. They have information value in and of themselves. If I can figure out the probability of default, I can probably have a credit worthiness or a ranking of the corporations that I can invest in, and I can maybe use that for my portfolio design. But again, this foundational model by Robert Merton, we're able to get closed form solutions. But some of the things that come out of it is having a single risk driver means perfect correlation between probability of default and loss given default and other things that maybe we want to engineer to reflect things that we see empirically. Okay, so with that in mind, this model by Levy and Hu, see my one of their, I guess, working papers, Moody's KMB, says that, sure, under a risk-neutral measure, my asset returns are like equation 1, but we're going to have now the market view of recoverable assets if a rapid liquidation needed to occur, and we're going to say that those recoverable shadow prices are going to basically look as maybe some sort of fraction or component or related to how the firm accounting is, but there might be other things that are influencing its evolution if I had to do a rapid liquidation. And so we say that instead of just having one risk driver, one single brand in motion, we say there's two, and we say that they're correlated. There's an instant correlation between the two. So essentially, we're going from what is known as a one-factor model now to a two-factor model. And again, we're going to assume the existence of a risk-neutral measure, which is a whole other discussion itself in financial economics. To say that there exists one. In the previous case, you could say that, well, equity is sort of a proxy on assets, but in here now we have two, and so we're going to really need to talk about bond and equity prices and how they evolve jointly. Okay, so going back to what our default mechanism is. Let's assume now that assets can evolve to any level that we like. Capital A is the firm manager, her accounting of assets. And we're going to say that bondholders, when they agree to buy this corporate debt, when they agree with the firm, the manager she's now writing up a contract to sell N dollars in the future for some money up front. In the contract she agrees to, they write in what's called a covenant, which says that if assets ever fall below a level K, then you are now required to liquidate your company. And so for this case coming up, we'll assume that K, that level, is less than the notional. So if, for example, if you owe $100 million total outstanding at time capital T 1 year from now, if any time between now and a year from now, your assets fall below $50 million, then we're going to force you to liquidate. So we call that a weak covenant. We can also talk about, if that covenant value is above the total outstanding notional, that we call a strong covenant. Okay, in that sense, now we're going to have a joint two-process evolution, assets and recovery. And we're going to assume now the default is within what's known as that filtration, or the sigma field at time capital T. If anybody does algebra, you've seen these sorts of things, sigma algebras, for example. And we're going to say now default is the complement of a set. If it is not true that the first time that I ever hit a lower level K is bigger than T, and that my assets at time capital T are enough to pay off the notional. If that's not true, if the intersection of those two events, if it's not true, then we hit default. So the complement of the intersection of tau K bigger than T and AT bigger than equal to M. That's how we're going to define default now if we allow for what's called a covenant. So if we do the expansion of what's known as the original Merton model to the Blackhawks model, that's our new default set. And again, just to play around with the parameters a little bit, if K ever goes to 0, K is this lower level. If that lower level is 0, a geometric Brownian motion is the exponential of a Brownian motion and some linear function of time, let's say. The probability that ever goes to 0 is 0, right, in finite time. That's related to law of iterated logarithm, or just other things you know about Brownian motion. So what I'm saying is that if K goes to 0, we will recover back the Merton case where there is no covenant. But if we have a non-zero covenant, this is how we expand our default model. And one thing to notice, for any sort of econometricians out there, I think sometimes people call this beta. This quantity here, gamma, which relates basically sigma A, which is how the firm manager measures the volatility of her returns, sigma R, the market, and also rho AR, the correlation of those two risk drivers, we can combine them into one parameter here, gamma, and we're going to see that, in fact, that value gamma is reflective of the risk that we're injecting into this model. What do I mean by this? Now, we're going to say that under the stochastic recovery Blackhawks model, so again, the Blackhawks model is the expansion of the Merton model, where we assume that there's a lower covenant, that bondholders can force a premature default even before capital T. Then we can say that's fine, that in this model here, we have that if there is no default, or if there is default, these are the two values. If there is default, then we recover the not value A at time capital T, but the recovery at time capital T, which is this correlated process. But if there is no default, then we recover N. Now, the way we do this is interesting because we're now able to segment the recovery risk and the default risk really in two pieces. This piece of the original value is untouched. And the only thing that's really changed is that we're replacing the assets with recovery R. But from a mathematical perspective, we're basically reducing a one-dimensional PDE. If anybody's ever solved the Black-Scholes PDE, however you do it using Feynman-Katz, change of variables, whatever you like, we're now going to a two-variable PDE with a barrier. And so there's multiple ways to solve this. We like to do it via integration because we're able to see exactly the result of where that risk is injected. So we're assuming that the risk that we're injecting is only going to be in the recovery part, not in default. So the default, as you can tell, is if it's not true that these two conditions hold, that we don't ever hit the lower level and we're able to pay off our total notional at time capital T. Okay. So again, some things before we go into the analysis of it is that the firm manager, she has her own internal accounting A. She has the final decision when to trigger default. R is something that the market is determining, and it's a shadow price, and the firm manager, she's aware of it. And so there's an information gap. Essentially, there's a spread of information where the assets are known, as well as sigma A, are known fully to the firm manager, right? But the investors don't necessarily know. So let's assume that the notional, of course, is known. And so really what we can show in our third paper, we talk about this. This is a calibration algorithm, which is for future work that I'd like to talk about. We can show that a investor, for them to price their bond, these are the 4 parameters that they actually need. So they have this thing here called distance to default, D0, which let me go back. I didn't spend enough time on it. Distance to default here, phi sub D0 is reflected here, or 5 minus D0, excuse me, is the probability of default. So think of D0 as the number of standard deviations away, let's say, from a quantity like a default point or a lower level of default, if you're not able to pay off your assets. Pay off your assets are not enough to pay off your notional, excuse me. So, if you're a credit derivative specialist, if you're a bond trader, you're probably going to think in terms of these standard deviations in here, D0. It turns out that adding that extra term for recovery does not affect D0, because again, we're only injecting risk into the recovery part. We're not injecting it into the firm manager and when she triggers default. So when I go ahead and look at bond and equity prices and their correlated, their associated standard deviations, that stays the same. But instead of knowing A and sigma A, which the firm manager, she knows, I mean, she could at any time summon her accounting department and get an accounting of, the firm's assets. As an investor, you can only imply what's going on. And it turns out that in our model, you can only imply R and sigma R. So not A and sigma A uniquely, but you can combine them jointly into D0. The distance to default, here you have A and sigma A, but they're combined into this function or standard deviation D0. And again, if you read papers, sometimes they'll call them D plus and D minus. We like to call them D1 and D0 because of what's coming up next. Okay, so from the original Merton model, which says default can only happen at one time, which is written to a contract, into a larger contract, which says that no, default can happen even before time capital T if your assets are way too low and we just think that we're never going to recover. We think that to discourage bad fund manager or firm manager behavior, we want to make sure that if your actions ever, if you're only, let's say, 50% of total notional at any given time, that's not good enough. You got to go into bankruptcy. We're not going to wait. We don't want to go any lower than that. We want to take what we can get. Okay, so again, A and sigma A are not known. There should be a apostrophe here. A and sigma A are not known individually, but they're known as the distance to default jointly. So this is where we talk about impartial or partial information or imperfect information. So as a investor, I can't replicate, maybe replicate is not the right word. I can't simulate what asset managers know because I don't know the A and sigma A uniquely, individually to simulate, the asset evolution. Only the firm manager can do that. But I can figure out D0 so I can do pricing. It'll turn out. So that gives us sort of a nice hierarchy of who knows what at what time. We were surprised that with this two-factor or two-parameter PDE with a barrier, using just plain integration and just pages and pages of it, we were actually able to get a closed form solution. So when we say W here, this is for the weak covenant, meaning that K is less than N, but even K is bigger than N, we get a closed form. And so where you see things in red here are, instead of R, it should be A, and instead of gamma, it should be 1 in the traditional Blackhawks price. And so the way I see it again is that we've injected risk into the model. Think of injecting plastic into a plastic injection mold. And where does that plastic accumulate? Where does that risk accumulate? Where is it reflected? Well, it turns out it's reflected into the original, if this was just the original Black and Cox model, just by replacing a couple different parameters. And we were really surprised by this at the beginning, but as we went through integration, we weren't so surprised because, it's just a matter of the calculations that we went through. So if you want to go through what we've done, that's available in one of these papers that we published, the first of 2 back in 2017. Okay, and those parameters D0, X0 are reflected or computed like this. Okay, but I have what's called a D gamma and an X gamma in here. And so how does my uncertainty of my recovery reflect into the total risk that I'm injecting into this model? So again, the sort of plastic that I'm injecting into here, if you think of that as risk, where is it accumulating? You know, what parts of this mold is it accumulating in? So it's accumulating into the distances to default D and X, meaning that in the original Black and Cox model that came after Merton, that expanded Merton, those are here in equation 10, but the extra uncertainty is reflected into how many standard deviations are we away from. And so it really is reflected in here by adding this extra uncertainty here, this gamma sigma A root T minus little t. And so the two places where we see it are in the recovery, R instead of A, but also in the probabilities of default that we're multiplying my recovery by. It's adjusted. It's not just D1 or D0, it's D gamma or X gamma. And so we were really pleased by this because, again, I've given this talk in different formats for different audiences, but I really wanted to talk today about, you have, in terms of, you know, financial modeling, you make an adjustment. What is the result of that adjustment? And here, the result of that adjustment is that the risk accumulates in two places. It accumulates in how I recover, but also how I estimate my probability of default. Okay, so again, I'm not, for the recovered part, for the notional part, I'm not adjusting the probability of default. I'm not influencing the probability of the firm manager and her accounting. I'm just trying to estimate it. And so, again, I have this sort of deformation, and that's something to talk about in a few minutes. I have this deformation of this recovered part from the original approach. Okay, we can also, I'll skip through this real quick. We can also evolve some of these later models that are neat to do with credit default swaps. And so again, we just replace assets with R, and again, we can get a closed form solution, and that's calculated in our paper as well. So if credit default swaps, think of these as sort of premiums where you're paying an insurance, you know, some part of your premium, some part of your income is devoted to, in case your bond went to default, how do you protect against that? And so there's some neat stuff on there, but maybe that's a bit further afield to talk about, but we can price those. What's really interesting to us right now is, again, at least for this talk, I wanted to talk a little bit about, you inject uncertainty into the recovery. Where does that uncertainty, that sort of plastic, that sort of fluid settle, you know, as it cools down? And so it settles in the recovery part, but also settles in what I multiply recovery by. And that was interesting to us. We didn't expect it at the beginning, but going through our calculations over and over again, we were very pleased to see, yeah, it does make sense. Okay, so again, we're going to assume now a joint coupled or bivariate process, asset and recovery, A and R. We're going to assume that there exists a probability measure that this lives under. And going back to it, let's say that if we only had a single valued risk driver, A, then at time capital T, that's our sigma field. And we say that that is contained within the joint sigma field, which is now contained, or filtration, excuse me, at time capital T, which is contained within the over the underlying F. So long story short, if you remember, under no stochastic recovery, we assume that if it's not true there's default, if it's the complement of the default set D, you get N dollars. But if there is default, then bondholders have first claim and they recover the assets. That's equation 13, just in a nutshell, what we've done at the beginning and some of the calculations we've seen. Fantastic paper that is not very, it's not cited enough as it should be, in my opinion. It says that, look, corporate bond pricing under these covenants, they can be just seen as option pricing under barriers. There's a very good link, and we've seen it in some of these calculations I've shown you. So in general, these Ishizaka and Takaoka, they say that, yes, this is just a change of measure problem. And if you've done, you know, things, for example, change of numeraire, or if you've analyzed the original Black-Scholes call option price in terms of change of numeraire, understanding why you have D1 instead of D0, for example, you've seen this kind of calculation before. But essentially, we're just assuming a radon-Nikodym derivative, a change of measure, under which we can go from one risk neutral probability to another. Okay, and so we said that, okay, if you can do that for assets being A, then maybe we can look at what we're doing as, under recovery process R. So if you go through their calculation, they're just saying that, look, the value of a non-stochastic recovery where you just, maybe that's a bit of a misnomer that your recovery is A, not R, is what it should be. This is the present value of notional times the probability of default, sometimes probability of no default, excuse me, plus now assets times this new risk neutral probability under our change of measure of the default set D. And again, this is something, if you've solved the Black-Scholes PDE and written it out, this is, again, change of numeraire from P to Q. Okay. Well, in our pricing, we say that's fine. Let's go from P to Q star. And we say that that translation is under now another risk neutral probability measure change under Radon-Nikodym derivative Z star. And I'm going to, instead of calling it PT, I'm going to call it PT bar on the top, because I'm now going to condition on the FT of the joint process A and R. Okay. And so now under the total filtration F, it turns out that we can write our solutions we had before just like that, just like Ishizaki and Takaoka. But again, instead of A, it's R, and instead of QT, it says QT star. And so another way of looking at how this injection of risk into recovery, injection of recovery risk, is that we change assets to recovery, or market determined recoverable assets, and we just deform to another probability measure here. Okay, so again, the trigger set D remains within FTA, meaning that the trigger set is just within the asset only, A only sigma field, the time capital T. The joint process is not really needed, because again, only the firm manager determines default, right? And so really what we're truly interested in is seeing how this QT star evolves. And we'll show some basic calculations for that. So we have a definition, and again, this is our second paper in our 2017 approach. So we wrote 2 papers out of what turned out to be a trilogy, and the third paper I'll talk a little bit about at the end what we've done. But the second paper to say, well, if we want to expand the kinds of models that we look at, is this a general framework for pricing bonds? Meaning that you have the present value of the notional times the probability of no default plus recovery times this deformed probability of default. And it turns out, yes, we think that it is a good approach of doing it. And so maybe this is another sort of paradigm for traders and analysts to look at, is to say, well, can I capture these two things here? And if you remember, again, products of things are interesting to traders when you look at probability of default times loss given default. We're saying that recovery times the deformed probability of default, the deformed probability of default, that's an interesting product to look at as well. Okay, so in this case here, we have what's called the partial information transform, PRT, and I did that sort of in honor of where I did graduate school at Carnegie Mellon in Pittsburgh, so PIT for that. That was a little nod to where I learned a lot of my math finance. This transform is essentially transforming the understood probability of default into this deformed under a recovery matched or recovery derived probability of default. Okay, and so that was in our second paper in 2017, and we could even expand this reasoning to things that people like. For example, well, recovery maybe should be just a fraction of the notional. It shouldn't be bigger than notional. Not that that's impossible or it's never been seen. It has been seen, and you could argue, you can recover more than the notional, for example, after total bankruptcy costs are taken into account, or if the firm manager mistakenly went into default, underestimating the true value of the internal assets. So recovery can be bigger than notional. But if you want a bounded recovery process, this notion here of recovery times deformed probability, this quantity here, is actually possible to price bonds under a different default mechanism with a different asset evolution. But just keeping the joint A and R, where they're both geometric Brownian motions, yes, we can call this a partial information transform. and we can have some basic calculations. And so a lemma in that second paper in 2017, in volume 4 of the issue number, I forget what it was, 26, there's in fact a general lemma that we can show. And a couple things that come out of it is that if gamma is equal to 0 or gamma is equal to 1, we actually do recover the understood, if there's no correlation between recovery and assets, then gamma should be 0. And if there is perfect correlation, if assets and recovery are the same, then gamma should essentially be 1. And then we get back the original Blackhawks model. So we were excited about this. Just again, a lot of this turned out to be just calculation pages upon pages, but we were able to get it to work. But we also think that it's a good extension of how to analyze these kinds of pricing models. Okay, so an example. Let's go back to the Merton case, where now instead of A, we recover R. We can show that again under deformation QT star, our default probability is QT star. That default does happen, so it can only happen at time capital T. So it's the probability that A sub T, my assets are less than notional. And again, if you went back to our pricing that we have in one of our papers, we can show that this is true. And again, this is just by mounds, piles and piles of calculus. You can show that this quantity is true. And so substituting everything back into equation 21, yes, we have that our deformation QT star of D is not 5 minus D1, it's actually 5 minus D gamma, where again, gamma is this parameter calculated. And for everybody that works in actuarial science and has looked at sort of incomplete pricing that's using what's known as the Wang transform, I believe, Sean Wang did this, foundational paper talking about how to price, I think, earthquake insurance. Yes, this definitely overlaps with that kind of thinking as well in actuarial science. Okay, so last thing to talk about, and very, very quickly, I think I'll just go through it quickly, is that in these models here, assets and recovery are both continuous, meaning that there's no surprise. There's no chance that some information can come out that there was improper accounting. There's some sort of illegality going on, where assets and recovery, either or both, can jointly or individually be driven down to 0, meaning that all of a sudden, overnight, your assets are worthless because you're forced into bankruptcy externally. So these sort of price fluctuations use the extension of the original Merton model by another, I believe, Nobel Prize winner in Paul Samuelson. And so we use basically a Levy process or a jump diffusion process. And so just very quickly, this is how my assets and recovery jointly evolve. Adding, of course, these sort of drivers down to 0. If information came such that we push it to 0, these are my assets and recovery as such. I can get this kind of nice solution for it. I might be missing a minus somewhere here. Anyway, probably not in the solutions. But just very quickly, in the interest of time, because I'm kind of, getting a little bit close to the end here. So I can say that the rate of these Poisson processes jumping, these capital N's, lambda sub A and lambda sub A sub R, AR jointly, they can be reflected in my interest rate R prime. I can adjust my interest rate R with no jumps to R prime by adding the jump rates. I can therefore go back to my original, let's say, Merton model. We're going to talk about the stochastic recovery Merton. So again, no covenant in this case. And I can talk about how I can adjust or get a closed form solution for my price if I do allow for jumps. So the no jump price is just comma R prime, just one parameter. And allowing 4 jumps, lambda A and lambda AR, you can show, and again, these are calculations we've done in our second paper, that this is now my adjusted value for bonds under the recovery Merton. So you can only default at time capital T, or if you're driven down to 0, that's going to be reflected in what you recover at time capital T when you hit that time. So even though the default happens early, technically the true recoveries happen at time capital T. And we can show that we have these nice sorts of deformations of probability of default to QT star as such. So it's really segmented into 2 things. Either you jump down to 0 because that's the information coming in, and you have this fluctuation to 0, or you survive till the end, but then you've got the assets being less than N. And again, these are just calculations, calculus that you can show to get these answers. So as I finish off here, let me just talk a little bit about this modeling approach, this paradigm, which is that you inject risk to say, look, I'm only going to do one thing. I'm going to let the bond issuer, I'm going to let the firm manager, she can determine default. But I'm going to let the market determine what the true value of recovery is. And so for me to do that numerically, we've done that now in our third paper. We've extended this model. We're going to assume no jumps for now. But in our third paper coming up in Journal of Credit Risk, we talk about, well, okay, how do I actually simulate these values? How do I simulate and say if I was given bond and equity prices that are now not perfectly coupled because there's not just one risk driver, how do I get estimates for the row AR? If I know what bond and equity prices, what their correlation look like, how do I map that to a correlation for the AR, asset recovery correlation? How do I, for example, talk about, how do I estimate sigma of R? What should my R really be? What is my recoverable value supposed to be? How do I do these kinds of estimates? So that's what we've talked about in our third paper. And getting these solutions is really, solving these parameters. You're looking at 4 equations, 4 unknowns, bond, sigma bond, equity, sigma equity, volatility of bond and equities, my sigmas. That's a numerical exercise. And, to do calibration properly, that's another paper, even that by itself. So some of the things that we're looking at in the future is to expand this kind of reasoning to other kinds of products where we believe that recovery risk is money being left on the table. If you just assume that your recovery is entirely assets or some fraction of assets, but a constant fraction of assets, not a evolving fraction of assets, then you're leaving money on the table and you're mispricing risk. You're not getting as much credit spread, let's say, as you should deserve for investing in a bond. We can also expand this now into other kinds of products like coupon bonds. Coupons are just more calculations to plug in. We can actually have different kinds of default mechanisms and even different kinds of recoverable processes. We've done that in part number 2, the second paper, which is open access available to anybody through risks. But our third paper, we've talked a little bit about, well, how do I actually put this, let's say the basic model into practice? And we've got some nice calculations there as well. But if anybody's interested in this kind of material and calibrating it to data or solving some of the problems that are, fixed point problems, to actually try to find, a 4-parameter solution for nonlinear equations, nonlinear with unknowns. Lots of work to be done in the actual application and implementation of this model. But in terms of theory, this hour that I really appreciate you spending with me, the result is that if you inject risk into a model by saying that, look, there should be an extra parameter to reflect uncertainty of what you'll recover in a fire sale, in a recessive environment or not, how does that risk settle? And we say that it settles in 2 things. It settles in the fact that you can replace A with R in your calculations when you talk about the recoverable piece, but it also mutates, it transforms your estimate of the probability of default because you change the measure. You go from, let's say, D1 to D gamma, that you're not as certain about how far away maybe. You're not 1 standard deviation away, you're standard deviation plus some extra uncertainty, some extra error term that you're looking at. So we think that that's an interesting paradigm for, bond traders to think about, that if you allow for more market information, how is that reflected? We believe that this is a sort of internally consistent model. How predictive it is, of course, depends on how good you are at calibrating, and that remains to be seen. So if you don't mind, let me stop sharing these slides and just thank everybody for spending some time with me here. And if I could just come back. So I hope I didn't lose too many people there. That was a lot of Wall Street type finance, but everybody was forewarned. That was the title of the talk. Any questions or any comments on what we've done, or what we've done, basically? What was the value of it?
So should I talk, or Antonio?
Please, Celso, go ahead. The floor is yours.
Well, I will speak in Portuguese just to be more helpful for the audience. Eu queria agradecer o Albert pela ótima palestra e gostaria de saber da audiência se há alguma pergunta.
Até agora não, Celso. Eles se manifestam aqui pelo chat.
Pois é, eu estou olhando aqui no chat. Eu vou fazer o seguinte, algumas perguntas, Albert, para você, simples. Nossos estudantes, nossas faculties, né? Eles não estão muito acostumados a esse tipo de matemática aplicada ao mercado, né? Você poderia dar um pouco de situações práticas de aplicação desse tipo de matemática, aonde que você pode aplicar efetivamente esses modelos?
Claro, muito obrigado. Muito obrigado por essa pergunta. Então, no começo, quando você pensa, eu vou falar em inglês, me perdoa. Então, essentially, when you want to try to model a process, whether it's in physics or financial economics, you want to have a starting model. And so the first idea you could argue is that this is what's known as an option theoretic approach to pricing credit derivative. So what's an option? An option says that I'm going to trade a fixed amount of money for a variable amount of value of a stock whose value is varying at a future time. So for me to make that trade, I need to give you some money up front. And so the argument, to answer your question, the question was, is there a sort of a basic implementation or a basic kind of field where you can apply this kind of reasoning? I would argue that whether you're doing any kinds of modeling in insurance, finance, or physics, the question is, what are you trying to value? And I would argue that in here, instead of trying to figure out the initial energy of, let's say, a configuration of a system that you find it in, let's say, lowest energy state, you can argue that we're trying to figure out the value of some risk associated with transferring in the future a floating value for a fixed amount, let's say for an option, or in this case here, if you're opening yourself up to a extra factor to reflect that what you might recover is not what somebody tells you that they're going to recover if they're the ones handling the bond issue, but you're going to open it up to a market valued evaluation. Then how does that reflect in the final calculation? So I guess I'm kind of dancing around the issue. It's a bit vague, my answer, but I would argue that this kind of calculation can be seen in multiple ways. Number one, just in and of itself, the sort of kind of implicit in here, but solving equation 8, where you've got a final time value with a barrier, that's solving a 2-variable partial differential equation, right, with a barrier condition on it. So one of the applications would be to say to just neglect for the time period what the financial implications are, but what's a good way to solve this numerically, right? Because I could maybe add other covenants, right? I could add, let's say, that instead of the asset itself should always be above a certain level, I can say that, well, maybe that's a bit too stringent. Maybe having the average of value over a certain time be above a certain level. That, yeah, I can dip below, but if it's just a quick dip down and then going back up, that shouldn't affect how confident I am in the firm manager's ability to guide the company. So maybe I want to have a maybe more complex barrier to determine the value. And so with that in mind, I could argue that one of the first applications of this would be, how confident are you in solving partial differential equations with more advanced barriers? Are you comfortable in adding an extra variable, or would you want to do some kind of transformation of that variable back? So going back to the original Black-Scholes PDE, the way that it was originally solved was translating it back to the heat equation under a change of variables. And I would argue that's sort of the trick that we're doing in here, is that we're, instead of looking at change of variables to solve a PDE, we're kind of looking at change of variables or under this guise of a change of measure, essentially. And that's how we solve this problem. And we try to say that's a good approach to generalize bond pricing. So I think for students looking at this, to say that it's a model that reflects financial economics, but there's multiple tools that if you were to go into industry that they might ask you to solve. One might be to solve the partial differential equation well using numerical techniques, and techniques that are robust enough to add in different kinds of covenants, different kinds of barrier options that will trigger default. That's a great question.
You answer my second question, because I would ask you about which were the mathematical challenge that you just said to solve PDE with barriers numerically.
Yep.
That's the big challenge.
Yep.
I see.
One other thing that I would argue is that, and I realize I didn't put in my slides here, which is
Celso,
yes.
I think I'm hearing some background noise. Maybe your speaker is too loud. Are you using one or two computers?
I am using just one.
Okay, because we are hearing some echoes here. Please go ahead. Sorry for that.
It's okay. So one of the things that we noticed is that in solving these problems here, there was calculations using Feynman-Katz or just integration, and that was a fun approach to doing it. But numerical analysis definitely has a place in here, because you're going to do numerical analysis for solving parameters that are, what is sigma r? I mean, it's sort of an imaginary process. It's recovery. It's an associated process, R, but it's something that's implied, you could argue, from equity. And I didn't really talk about this, but the Miller-Modigliani, another pair of Nobel Prize winners, in the absence of market frictions like bankruptcy costs, taxation, the argument is that the firm assets are equal to equity plus debt. So there's a single risk driver of assets, and they inform both equity and debt evolution. But if you allow for now decoupled risk drivers for A and R, then you've got to add in more empirical data, and you might want to have, let's say, a robust numerical approach to this that solves maybe a PDE or some sort of numerical integration, as well as implying out what those parameters are, maybe as new information comes in. So to actually implement this model would be interesting just from a mathematical perspective.
Which are the main parameters for these models?
So for a bondholder to price, you need to have recovery value R, the sigma R, and we say that those are harvested directly from equity. And then you also need to know what the D0 is, the standard deviation away from default, which is not knowing A and sigma A explicitly, but jointly in D0. And then finally, you need to know rho AR, the correlation between the two risk drivers. If you know those four parameters as well as the notional, then you can price bonds.
And how do you guess them?
Basically, that's a great question. And that's what we've got in paper number 3 coming up. And so we talk about that. If you've got bond and equity prices today, so you're looking at a company and you have a way to say that this is the total outstanding notional for a company. And that's kind of hard, because a company might offer different bonds at different times to raise capital. So there has to be hopefully one reflective notional with one time to maturity that reflects everything. So if you could have a proxy for one bond and its volatility, and equity price and its volatility, those are four observed quantities. And so if you could say that, look, I know that my total outstanding bond value is something, my total outstanding equity is something else, the sigma of that bond is 20%, the sigma of my equity is 25%. Those are 4 observed values. And if we assume that our equations are perfectly correct, then we calibrate by saying that those 4 quantities lead to 4 equations for my 4 unknowns, nonlinear equations, by the way, and I have to use some very good, numerical methods to solve for what those 4 equations are. So again, unfortunately, I don't have a blackboard here, but essentially 4 equations to find those 4 unknowns. Those 4 equations will be related to bond, equity, and their corresponding volatilities.
And all these models are sort of academic models, or company really use them when
academic
they go to the
models.
bond markets?
That's what I was hoping somebody in Brazil would want to use our model after this talk today. It's my belief. I mean, we think it's a good internally consistent model. Our 3rd paper, which is coming up, which if you'd like to invite me back in the fall, closer to the publication of it, we believe that there is a way to get some good numerical simulation. But it's a good question, like how easily implementable is it? That's something that we're still working on and thinking about. But certainly, when you look at the future of financial engineering, you could argue that, reduced form models where, look, default happens with this hazard rate, sort of like in insurance, like, insurance claims happen, whether it's a car accident, property casualty, or unfortunately somebody passing away, with life insurance, they happen with a certain mortality model or a certain hazard rate. Those are, also have a good, value in this kind of bond pricing. But I would argue that machine learning and data science type models also could be good at predicting and pricing as well. So it really depends on how much a company wants to have a structural or an internally consistent model to back up their predictions. They might say that, look, we just want to know what the probability of default is. What's your estimate based on historical data, based on, I don't know, whatever data you're harvesting now that's coming up. And so to have a model like this, it's really comfortable for an academic setting, but it's a fantastic question you're asking yourself. So like how implementable it is. We're finding out that we've got some good numbers that are coming out in our third paper. But yeah, I would argue that there's other models that people use very comfortably that they might want to hold on to.
Another question. Antonio, do you have any question?
Oh, please go ahead.
Most of the time we hear about markets, we heard about stock markets.
Yep.
But we are talking about bonds markets, how far apart are those two markets in terms of model?
That's an excellent question when we talk about correlation, right? I mean, sometimes bond and equity are highly correlated, sometimes they're not. And that reflects, also in our calculations in our third paper, in how well asset and recovery is correlated too. That's another way to harvest or calibrate these models. So it depends really, what investors want. Investors might want to, in a certain kind of recessive or non-recessive environment, direct their money into bonds or fixed income. Or there might be, regulations where you're forced to invest more in the bond market, let's say, instead of stocks for whatever reason. So it really depends on multiple factors, the current, economic landscape that you're investing in, the sort of regulations of what you're allowed to invest in as well. But you can certainly see, just looking over the last 10, 20 years, that sometimes stocks are more attractive than bonds or vice versa.
Okay, is there any questions from the audience?
Yes, I have a question. If you allow me, also. You asked him about real-life problems and academic problems. So when you're dealing with real-life problems, what is the difficulty to get the data in order to solve the PDEs that you have to?
That's an excellent question. So again, to get, for example, sigma R and R is something that you're going to want to do some kind of calibration. Those are part of the 4 quantities that are needed to actually get a price out according to our model. And so getting bond and equity data that you're comfortable with is hard, right? Because you might want to talk to a company that's, aggregating that data for you in a way that's easily estimatable. And the other thing is, there's different issues of bonds with different times to maturity. And so in this model here, we have 1 bond issue, 1 equity issue. And so to get a proxy that you're comfortable that reflects all the outstanding bonds is difficult. And I will say this, that other bond pricing models have to think about that as well. And we're not the only one. But that would be one difficulty that remains in ours is, what is the notional outstanding? And corresponding to that, how much time is left to when it's coming due? When is it being redeemed? That's a modeling decision that you have to make. And so when you do that calculation, you estimate D sub 0, and then you say that phi of minus D0 is my probability of default that I'm estimating, right? The higher the probability of default, the less creditworthy the company that you're analyzing is. And so you want to make sure that definition that you're using leads to a comfortable probability estimate for default, right? So that's a direct problem. That if you're not even using this for bond pricing, if you're just using it for estimating D0, for example, and you want to say, look, I just want a more reflective model of D0. So I'm going to go from a 2-factor model, which is A and sigma A, right, to R, D0, rho, and my mind is blanking on the 4th parameter. But I'm only going to harvest D0 in the end. you want to make sure still that the notional that you're using reflects the total issue of bonds in a way that's comfortable. That the person that's buying that information from you or accepting that information from you is happy with. And that's a whole other modeling question for our model. Like, which notional should you be using? We made some decisions in our third paper, but we could make other ones too, and they could be just as reasonable.
I see. Thank you very much.
Great question. Thank you.
Okay, so
before I go, I just want to say one more thing, which is I wanted to thank, I don't know if folks can see this, but let me just share the screen real quick. Can folks see my slides if I do this?
Yep.
You can see my slides. So just want to thank a whole bunch of people. First of all, Joe Campiglietti at Wilfrid Laurier out in Ontario. He actually introduced us a really good paper on barrier options that really helped us. Peter Carr at NYU, Nick Costanzino, dear friend of mine, co-author on these papers. Really excited. Stephen Mildenhall was at St. John's, also in New York. Austin Murphy at Oakland University, really great conversations with him. Harvey Stein, who's at Bloomberg, he really gave us this notion of what we were doing seemed to be reflective of partial information. And talking about implementation, Aditya Vishwanathan, who's at University of Michigan in Dearborn, really helped us with some coding in MATLAB to figure out how to do these sort of 4 equations, 4 unknowns, and solving. So just wanted to thank all those gentlemen there. And yeah, I couldn't have done this. I've learned a lot from Nick in the financial world. So he's a dear friend of mine and a very valued, treasured co-author. So just before I went, I just wanted to talk about those gentlemen there. Thank you.
Okay,
there is no further questions. I would like to say thanks for Albert.
Thank you. Muito obrigado.
And I hope see you again in our colloquium soon.
I'd love to. I'd love to talk about our latest results and answer some more of these questions. We have some partial answers to numerical questions, solving, I wouldn't say solving PDEs, but at least harvesting parameters. We definitely have some answers, partial answers to share.
Okay, thank you very much, Albert.
Thank you, my friend. Tchau.
Bye-bye.
Tchau. Obrigado a todos. E assim eu me despeço também dos alunos que estão acompanhando aqui a palestra. Até a próxima sexta-feira. Hoje nós tivemos o Albert, que foi uma indicação aqui do Celso, né, como palestrante. Muito bem-vinda. A palestra foi bem legal. E na próxima semana nós vamos ter uma indicação também do Maicon dessa vez, né? O professor Eckstein, que é especialista em otimização convexa, vai dar a palestra na próxima sexta-feira aqui no nosso colóquio. Senhores, muito obrigado. Um abraço a todos e até a próxima sexta-feira. Stay safe.
Stay safe.
Antônio, nós continuamos no YouTube, não?
No momento eu vou terminar aqui a transmissão.